Hello guys, welcome to the Trading Parrot. We have almost the perfect recipe in here for further rejection at an RSI of 58, thanks to almost completing the CME gap in here. But at the same time, right above 60K, we have seen large chunks of liquidity pools. Let's discuss what needs to happen with the price to go for those higher levels of liquidity, and how will it look at rejection from these levels to potentially still target the lower CME gap that we formed a week ago. We'll cover the daily time frame, and I'll show you this triangle which I'm using almost as a cheat code to tell us whether we are gonna target the top of the megaphone pattern next, or if we are still gonna come and grab the lowest and largest liquidity pools currently formed in the past 6 months. Guys, if you like this type of content, make sure that you're subscribed to the channel, hit the notification bell so you get notified every time I put out one of these videos. We continue to make more than 150 likes consistently with every single video. I really thank you for that, guys, and I will continue to publish one video per day to keep you informed, which is something I have done throughout all my holidays. I'll be back 100% to work next Monday, and I will really appreciate if you can continue. That's really helping the channel to continue growing even if I'm in the middle of my holidays. Let's go to the content. Starting with the 4-hour time frame, we can see that after the breakdown of Sunday, which I insisted will be the key to understand whether we are going to break down and go for the lower liquidity, we can see that after the impulsive move up to 45, it has been slowing down on the move to the downside. It finally found a pivot at an RSI of 40, and it's currently going towards the resistance located at around 58 RSI. Let's find out what price corresponds to 58. 58 is 59.6K, which is almost the end of this fair value gap that we left in here. Currently, the price is in progress taking that liquidity after a strong bounce on the middle CPR pivot from September. Notice that before we broke down in here, I mentioned that to stay bullish for continuation to the upside, the CPR level was going to be key to understand the difference between potentially aiming for higher and a breakdown below the CPR levels pretty much guarantee going for the lower levels. So far, so good, because we have bounced first on the top pivot and then later on the second pivot 4 times. Right after that, we are shooting back up. Why are we going up in here? The answer is to hit that resistance of 58, number one, and number two, to take the CME gap that we left unfilled over this weekend. The end of the CME gap is at 59.9, and there's only $500 left to take before we complete filling that gap. So the question now is, if we were to close this gap, is it going to be just automatically that the price now needs to come back in here and fill the lower gap? It's not that simple. For that, once again, we're gonna have to use our best friend, the 4-hour time frame in here with the resistance at 58, to understand whether we can start aiming for higher levels of RSI. Being at around 50s is not really impressive, it's the middle of the range, and a breakout around 58 could potentially offer us levels above the 71, which currently, statistically speaking, is telling us that in the recent past, the RSI hasn't been able to cross above 70. But make no mistake, if things get bullish once again, we could break that band and eventually be back at levels of 80. And I think it's a matter of how investors are going to react to the Fed interest rate decision, which is happening tomorrow. Expectations are still of 25 basis points versus 50, but there has been yesterday some requests from the government for Powell to consider even 75. I still don't see that 75 when I look at the Fed Watch tool, which is currently showing us that the probability of 50 basis points has increased substantially. A few days ago we were 50-50, now we are 65 versus 35. Most people on social networks tend to look at this in a very simplistic way. If we get 50 basis points or 75, it's more bullish, and if we get only 25, investors are gonna get disappointed and crypto should crash. I don't think it's that easy, and there are other more important factors in play. For example, the perception of investors that decreasing too much on the first cut might be an indication that we are due for a hard landing and recession. So it's a little bit of a mixed bag between that interpretation versus the naive one of thinking, let's cut the most that we can in a single cut and everybody will be immediately happier. Personally, I prefer to stick to the charts and see if we get a rejection at 58 for continuation to the downside, which I already mentioned is 59.6 more or less. If we break and we hold a 4-hour candle fully closed above it, then we start increasing the chances to go higher. On the daily chart, we continue our trajectory right as we define it in early September. We completed this pivot, then 60 was the top pivot, at least until now. Now we're printing a green candle in there. If that got rejected once again and we continue printing lows, we will continue with our expected trajectory. If you're new to the channel, I remind you that I'm putting this as an extreme in preparation for potentially wiping the low liquidity that is the highest liquidity that we currently have in the past 6 months. We don't necessarily need to get there, and if we found a pivot somewhere here, it will get much easier, but my trading style is always to prepare a little bit for the worst. Notice that today I have a new triangle embedded within the megaphone pattern. The megaphone pattern is the larger picture the last 6 months where we continue to print lower lows and lower highs, but this triangle here is what I'm currently monitoring for the shorter term on the daily time frame. Why? Because we could break out from this 60K, invalidating my pattern in yellow, or we could go as low as 52.8, find a bounce somewhere here, and then make things easier. Or if we don't find support at that 52.8, then we increase the chances of wiping the lower liquidity. So this triangle is going to help me to understand the likelihood for us to go to this area or to end up going to this area, which are the two extremes that, in my opinion, offer a better risk to reward for an entry. Being in here is kind of nowhere's land. It's half bullish, half bearish, and in my opinion, not necessarily a great area to take a high risk trade. Not to mention that tomorrow we have the largest event possibly of the past year when it comes to the macroeconomy. And if you decide just to enter from there, it might not be the best idea. And you might be wondering, but you told us that you are in a long. Yes, I am in a long. I enter, as I mentioned, 59, 57, and 53.5 public entries, and my plan continues to be to ride that average up if we exit from here and add at 46 if we exit below the same triangle. Guys, notice as well that all my moves are not just going to be tracked from today and on Twitter, but I found a way to synchronize my posts between Twitter, Telegram, and Instagram. You can find the details in the description to follow me anywhere you want, but those 3 platforms are going to contain all my TA updates going forward. Also notice that I'm on holidays for the rest of this week, and my pace on updating you on those social networks is a lot slower, but once I'm back 100% to work, expect many updates during the day of each and every single move of the price to make sure that you stay informed. Let's look at the daily RSI as well. And one thing that is in confluence is that this triangle at the top with this triangle here on the RSI are pretty much in confluence. You can see that the highs are touching this line in there, which is not always the case on RSI, and the same at the bottom. And it could be the case that the RSI breaks out from the top before the price does in this area in here. And for that, I'm gonna make sure that I send myself an alert in case we break out to keep you informed. The alert is ready, and as soon as I get it, I will inform you in those 3 social networks. that works, along with anything else that might happen differently. So far, the open interest is still holding the 17 million support resistance level. Not holding it could take us in a ride to the bottom end, which typically coincides with the lows of the past 6 months. But if we hold this level, similarly to what we did around April, May, then we could be heading for the top of the range too. That's why I continue to monitor the open interest as well. Wells continue in their trajectory to accumulate and withdrawals are outpacing deposits. Right now we are at 0.79. No news of any distribution so far from big wells. Megaphone pattern continues in this trajectory to the top. Nothing has changed so far. Volume on the daily is reaching the bottom levels. In the oscillator, we can see we are at minus 20%, and that is typically in preparation for a larger move, which doesn't surprise me. Everybody is with all eyes on the Fed tomorrow, on the decision. Even the dollar index is hitting the last line of support at $100 for 4 weeks in here. On the daily is printing a nice M pattern and holding the last line before breaking down. So potentially, if investors perceive that the cut was sufficient, this might start the journey to break down, just like it did in the bull market of 2020 and 2021, where we saw the dollar crashing and Bitcoin going for the last parabolic move to all-time highs. Although we have the CME gap in here unfilled and we are in the process, as I'm recording this video, of taking it, we have already taken more than half of it. There's only $500 left to complete it. When we look at the liquidity, if we get to that 60K, notice as well that we have quite a decent chunk of liquidity starting pretty much from 61K to 62K. So do not be surprised if right after taking the CME gap, the price decides to continue slightly higher to take this liquidity as well as part of the reward, not just coming from the CME, but also from these liquidity pools. Don't forget either that the higher the price goes, the larger the liquidity pools for the price. In here, what I see is the recipe for a potentially short squeeze, but that short squeeze is not gonna happen if people get disappointed with the rate cuts. So don't assume that the price, once it touches this, we automatically take for granted getting to the top in here. For that, there has to be full agreement that whatever the Fed delivers is really positive for the market. And for that, most likely tomorrow, I'm gonna keep an eye on the stock market, whether we see a new all-time high, some other interesting developments related to the dollar, gold, and other indexes. If there is disappointment with the outcome tomorrow, we could be heading to 56, followed by 54, but the larger chunks only start at 52.5, you can see in here, up to 51, in confluence with the CME gap that we left from the previous weekend. If we saw a market crash with all of this, please do not be surprised if we reach the 47 to 46, because I'm pretty much becoming a parrot repeating over and over again where is the largest chunk of liquidity. Looking at fire charts, the order book looks pretty thin to me, and I'm very sure that many players are not placing limit orders in the order book to keep their intentions private, so we cannot see them in here. As we approach the event, refreshing this page could show a different picture. I remind you that most of the tools that are here that I show in these videos are either part of my subscription or tools like this, Trading Different, Fire Charts, Trading Light, High Block Capital, all offer very nice discounts, and you can find the links in the description. Guys, I'm currently hosting a position airdrop on Bybit. You trade with $100 and they give you $500 to trade for free using any of the coins in the screen. Make sure that you have a look at the top link in the description to activate the promotion and see the instructions. I also left you my referral link, which you can use to open a new account on Bybit and unlock up to 30,000 in rewards. Using your new shiny Bybit account with my referral link, if you use it to trade with trading bots or with manual trading, you can get for free Observer, VIP, and even VIP call, as long as you have the minimum trading volume required for each of the tiers. And don't think that this trading volume is too much. For example, if you deposit $1,000 and you take 10 trades in a month, you already have what's needed for Observer. Or if you deposit $1,000 and your bots take 100 trades in a month, which is not that many trades for a trading bot, you are already entitled to get VIP for free. You can find these instructions on my Discord server. The link is in the description. I'll see you there. Take care.